Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Hi, I'm Lee Kelso here today with Casey Weade. He is a certified financial planner and the president of Howard Bailey Financial. You know, many people look at volatility in the stock market as being kind of a negative, something to be worried about, but there are some places where that can be a positive. We're going to cover the pros and cons of volatility in just a moment. But we want to start today with 5 taboos, 5 things you should never do when you're working with your financial advisor. Where did these come from?
You know, and some of these things that we're going to go through might seem like common sense, but these are things that I've actually seen happen to individuals over the years. And these things, if you make one mistake out of these 5 things that we're going to cover, it could cost you your retirement savings. And that's no over-exaggeration. It's really the way that it is today. We need to understand that we shouldn't take some of these things, we shouldn't do some of these things in our own financial life, or we're jeopardizing, our retirement. And they may seem very common sense, but other of these may stand out to you as well. I had no idea. So I really wanted to walk you through some real life examples. Believe it or not, these things actually happen.
Well, let's jump in at number 1. Never write a check payable to your advisor other than for fees. Now, in the age of Bernie Madoff, I'm surprised anybody would fall for that.
Yeah, you wouldn't believe the number of individuals that walk into our office that want to write. They say, well, who should I make the check out to? Should I make it out to you or Howard Bailey? Never make a check out to your financial advisor unless it's for their fees. So maybe you had paid a financial planning fee that's $500, $2,000, whatever it is, for them to structure the actual financial plan. Okay, but if you're going to make an investment, no legitimate financial advisor would allow you to, would take a personal check from you made out to themselves or their firm for an investment. You should be making those checks out directly to the financial institution, whether that's a mutual fund company, an ETF company, a brokerage house, an insurance company, a third-party custodian. That's where that check should be made out to. So it should be made out to Fidelity, it should be made out to Charles Schwab, or whatever that major institution is where those funds are actually going to be held, made out directly to the investment firm, never made out to your financial advisor. That's how Bernie Madoff made it.
Yeah, unbelievable. Number 2, never allow your advisor to list himself as a joint owner, beneficiary, or trustee on one of your accounts.
Right. I've seen this probably more often on the ownership side than the beneficiary side, but I've seen it in both ways, where the only place your financial advisor should ever be on any documentation whatsoever should be as of the advisor of record. They should be the advisor of record. They shouldn't be the beneficiary. Their firm shouldn't be the beneficiary or the owner. This is your money. You deserve total control over it. If you make them the owner, if you make them the beneficiary, then those assets you've now lost at least a little bit of control over. And that's something that I've probably seen more often as of lately than in the past. One of those primary reasons is they're naming them as the beneficiary, the advisor as a beneficiary, or the firm as a beneficiary. So if something happens to you, they retain control of the assets. You actually have to come in and get them to sign off in order to distribute those assets. So they're trying to gain more control, but it just seems wrong to me.
You know, this one is just crazy. I can't believe this would ever happen, but never lend money to your advisor. Never lend your financial advisor money. You've seen that?
Right. I've actually seen that at least once, and I know Marshall, another one of our advisors, has seen it as well, where people have actually loaned money to their financial advisor. I should just be able to stop right there and not really explain why that's such a bad thing to do, but pursuant to the Investment Advisory Act of 1940, your advisor is prohibited from loaning money or taking loans from clients unless that investment advisor is a financial institution in the business of generating loans. Okay. Does that make sense? I mean, I think you said something before the show that made a lot of sense.
Well, yeah, why would you ever see a financial advisor who has to get a loan from a client.
Right.
I mean, if you can't manage your own money well enough, am I going to trust him to manage mine?
Exactly. This is one that we need to put our foot down and walk out the door if your advisor ever asks you for a loan.
Number 4 here is never let your advisor list their firm's address instead of yours on the statement.
Right. What's the problem with that?
Well, you're never going to see what the investment is doing.
You're never going to see what's really going on.
Yeah.
And what has happened in the past is advisors put their address down or their firm's address down. They're now receiving those client statements, your statements, from the third-party custodian that tell you exactly what happens. That third-party custodian is really the policeman here. It's very important that you get those documents so you can double-check everything that your advisor is saying is in your account, or everything, all the performance that the advisor actually gives you. There needs to be checks and balances there. That's what those statements are for, is to make sure that you actually have what you have and it's returning what you think it's actually returning, versus a statement that's being facilitated and created in-house by your advisor. That's okay if they have some kind of consolidated statement they're providing you, but you also need one from the custodian to make sure what they're telling you is really what's going on.
Once again, Bernie Madoff technique, right? Never let a broker or advisor sell you an investment that isn't available to others. What's that about?
Exactly. Well, there's some institutions out there that are promoting proprietary products or investments you can only get from me or only get from us, right? And typically, if that investment's only offered in one place, then that means it's probably a higher risk, lower liquidity investment, or you're working with an advisor that just doesn't have the option to work with a lot of other tools. Maybe they're receiving extra compensation for selling that product that their company manufactures versus going out and getting it from another place that's completely independent. And I can probably tell you a number of different situations where this has occurred. One most recently was with a straight fixed annuity. So an individual bought a 9-year fixed rate annuity in December of 2015 at a fixed rate of 1.85% and a guaranteed minimum of not 1.85%, but 1%. So now that company can lower the rate from 1.85 to 1. This company was the only company that offered this individual product. We could have went to another A+ rated company and picked up a 3 or 3.5% fixed rate, given where interest rates were at that time. And think about the investment world like cereal. You know, that cereal you should be able to get from a lot of different retailers. So the same thing should be true about the investments that you're purchasing, or the insurance products, whatever it is, should be available from a lot of different individuals, not just one person.
Well, something you won't get from a lot of different individuals is great advice, and that's what we're going to offer for you today. For the next 10 people who call us right now, we're going to offer a complimentary financial review of your entire retirement plan. It's an opportunity to get an education about your money, because you need to make the best decisions for yourself going forward, and that requires an information base. So for the next 10 callers, Casey and the team will be making some time on their calendar to sit down with you and give you your very own purpose-based retirement. Marshall Johnson joins us in just a moment. We'll be taking a look at the pros and the cons of market volatility.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
We're going to focus on the pros and the cons of market volatility here. We've asked Marshall Johnson, the Vice President at Howard Bailey, to join us for this segment. Why are we talking about volatility now?
Yeah, I think that's a great place to start. When we talk about volatility, we're talking about the market swinging, right?
Right.
There was a period of time, Casey, we've had an accommodative Fed here, Lee, for about the last 8 to 10 years. So really we haven't seen much volatility because the Fed has been doing so much to kind of funnel money into the system and keep the market rising. So now is a time where folks need to really have a plan for volatility, and it can be a good thing. It's not just a bad thing.
Yeah, and volatility has increased a little bit over the years, but if you look at it from a long-term standpoint, volatility isn't wildly greater today than it was back in the 70s, for instance. But what we see if we look at day-to-day activity is huge swings in the market on a daily basis, and that creates a lot of anxiety for individuals, and it also creates some opportunity at the same time. There's pros and cons to volatility.
Well, let's jump into the pros. What do you see as one of the positive opportunities within volatility?
Well, I look at it, Lee, a little bit like, it's like the stock market is a store where when everything goes on clearance, most people run for the hills, right? So use that as an opportunity. Have some dry powder, have some cash set aside that we can then go, have a shopping list too. You want to know what you're getting into, but when the market drops 10, 20%, I want to buy. I want to use that as a good opportunity for picking up good stocks at low prices.
Yeah. When we see the more volatility, we see the more opportunities we're going to see to get things on the dips and get things at better prices. I think another one of those things is mainly for younger individuals. So that's where volatility is the most beneficial. When we see a lot of ups and downs in the market, that's a good thing for young individuals because what are they doing? They're putting money at regular intervals into their 401ks, or at least they should be. And as you put those dollars into your 401k, you put a flat dollar amount out of every paycheck into equities, typically some type of index fund, hopefully. And as that occurs, when the market dips, you're able to pick up more of the market. And when the market's high and it's priced a little higher, you're getting less of the market. Effectively, you're dollar cost averaging, you're lowering your costs, you're timing the market without having to know anything about how the market's operating in the first place. So those are just a couple of the ways that volatility, these ups and downs, these big swings can be really good for really younger individuals, right?
So you're on the other end of that scale. You're an older person taking money out of the market. That volatility is really a pain.
Yeah, so just what Casey described, dollar cost averaging, now we have reverse dollar cost averaging, Lee. You've built this nest egg, and now you need to start taking out $1,200 a month to meet your living expenses. So what you're doing is you're reverse dollar cost averaging, and those dips make it all the worse, because if you started with a portfolio of $300,000, the market loses 30-40%. Now our withdrawal rate that was 4 is now up to 5, 6, 7, 8%. Right. So it's that uncertainty of when we're going to need that income, Casey, that makes volatility very difficult for retirees.
Sure. So we're reverse dollar cost averaging, really, and that's one of the things. But there's these other items around what's really what we often talk about here on the show, which is the red zone of retirement. So those first 10 years prior to retirement and the 10 years after retirement are the most vital to your retirement survival, if you will. And there's two different types of retirement risks that you have there around the red zone. Is first you have that retirement date risk, those years before you step into retirement, and then you have sequence of returns risk, those years after you step into retirement initially. So those are the two big risks that we have. Retirement date risk, for instance, is when we're stepping in those first 10 years of retirement, what if we went through another 2008 in the next 5 years? You find yourself 5 years from retirement. I had a couple that were in this exact situation. They're 5 years out from retirement. As we looked at where they stand today, they've got enough saved so that when they step into retirement, they'll be perfectly fine. They don't even need to save anymore over the next 5 years in order to step into retirement and have enough. They just need to make a little bit of interest, protect their life savings, and they'll have all the income they need for the rest of their life. But they were still invested almost 100% at risk in equities, and they had a little bit in bonds, but they were all at risk. And if we went through a major downturn like we had in 2008, and we did that a year or two from now, and it took 4 or 5 years to get back to even, they would be forced to delay retirement. But we can fix that before it happens.
Well, I think that's what everybody is interested in is give me some solution here. What can you do to help me prepare for and manage volatility?
You've heard Casey talk on the show lots about the accumulation years versus those de-accumulation years, or those income years. So there's really a shift, and I think it starts with understanding growth versus income. I had a great conversation today with a gentleman who's 71. His wife was a few years younger, but he was all for growth, and he loved to see the big upside. He felt like he needed 6 to 10% rates of return, but really he didn't need quite that much return. So what I wanted to get him to focus on was dividends and being able to withstand some of that volatility. So Casey, we talk a lot about active management with our holdings. I think this is going to be a period of time where we need good active management. It's not going to be a passive. If we're going through a lot of volatility, we want folks to be able to take advantage of those opportunities and watch out for some of the pitfalls. So active management is one solution.
And you came from the mutual fund world, Marshall, where it was all mutual funds all the time.
Right.
And when we invest in mutual funds, often we might say, well, the people that are managing that mutual fund, they are actively managing it, right? They're making changes when they need to make them. However, that's not really the case, right?
Yeah, so you got to understand with a mutual fund, they're very limited in scope. They get a prospectus every yearly that they have to follow those rules, and they have to stay the course, whether the market is good or bad or sideways or left or right. So you need to have somebody on top of that, or just get out of the mutual funds altogether and get true active management because you're locked into those lanes. I saw wonderful funds lose tremendous amounts of money in 2008, and that's fine when we're 45 and we have time to go through those ups and downs, but when we're 65, 72, we don't have the ability to wait it out.
You know, it's kind of, our most conservative portfolio, I think, is really the epitome of that active management mentality. If we look at where we stand today, we're closer to about 70% fixed income in our most conservative portfolio that we manage for our clients. But if you would have looked at that portfolio 2 or 3 years ago, it would have been more like 70% equities and 30% fixed. A mutual fund can do that. They would be stuck within this box, and they could say, well, we can only add so much equity, we can only add so much in bonds, and they get stuck in this box, and we don't receive that true hands-on active management. And that's what the people I work with want to know that they have. They want to know that when they wake up in the morning, they don't have to worry about if we're selling Pfizer or buying Coke or getting out of equities, getting into bonds, that those changes are being made for them on a daily basis so that we're always putting them where they need to be no matter where the market's at. That's what active management is. But it's also a factor of income, as you stated as well. So I think the second solution to this is generating dividends and yield and income, focusing more on income than growth. When we talk about focusing on a growth-based portfolio, which almost everyone that walks in our office, they have a dividend yield that's around 1 to 2%. It's next to nothing right now. And if you have a retirement portfolio, it should be generating 4 or 5% in dividend yield in the form of income. If we look at growth companies, take Tesla, for instance. They're not paying a dividend, everything's being reinvested. It's a price company. We hope that their value doubles or triples or quadruples over the next decade, but there's no guarantee. They could file bankruptcy next year. Versus looking at companies that are in utilities, telecommunications, energy, healthcare, that are developing a good dividend. Well, as that dividend gets created, we can kind of go back to some of our pros and cons and look at opportunity, right? So one of the pros of volatility is that we have opportunity, but we need to have that dry powder, that cash that's on hand to take advantage of the volatility. If we have a portfolio that's producing 4%, 5% dividends, take $100,000 portfolio that's generating $5,000 a year in income. Well, as we take that income and set it aside, then when we see dips in the market, we can go out there and buy things like we did earlier this year with oil and energy companies. Through the first quarter of the year, we had some dry powder on the sidelines because of our dividend yield. We were able to go out there and pick up some good opportunities.
You sometimes talk about comprehensive planning as a solution to volatility. Tell me more about that.
Yeah, I think, Lee, you don't have to worry about volatility if you've got the right plan in the first place, because it's something that we're always going to go through. There's going to be something going on around the world. I think we talk about technology today and the way people can trade on their smartphones, and we see so much emotion because we've got tens of thousands of people turning 65 every day. We've got a large this boomer generation stepping into retirement that becomes very finicky and panicky. But if we've got the right plan in place, if we've got some assets set aside for our income, if we've got some stability, we've taken care of our growth, then we don't have to worry if you've got a comprehensive plan that takes care of those things, that gives you that true diversification, not just throwing it in a collection of mutual funds, but you've got true planning.
Which is being done often. You know, you sit down with your advisor and say, well, you only need to make 6% a year and everything will be okay. But what happens when all of a sudden your portfolio is down 20% or 40%, like it was in 08, like it was in 2001? When we have something major like that happen, volatility hurts us when we panic. And we might not have panicked when we didn't need the money. Now that we need the money, we may end up panicking, and that's where we get hurt. And as Marshall's saying here, if we have a plan that we've already covered your health care, we've already covered your retirement income, we've already covered all these different risks that are going to be there regardless of volatility in the market, then we know that this portion of our portfolio can endure some of those ups and downs. We have a Xanax for our retirement years so that we can step through, spend with confidence without worry that the money won't be there for the things we need it for when we need it.
You know, I think the first step toward that financial Xanax that Casey just mentioned is what's in front of you right now. It's an opportunity to be one of the next 10 people who call right now. We're offering a complimentary financial review of your entire financial and retirement plan. We talk about it often because it's an important opportunity to get an education about your money so that you can make the best decisions for everyone involved moving forward. So for the next 10 callers, Casey and the team will make time on their calendars, sit down, visit with you, and give you your very own purpose-based retirement. Our question of the day: which asset class had the best return in 2015? Some choices are on your screen. We'll have Casey give you the correct one in just a moment.
You may have a purpose for your retirement, but have you repurposed your assets to help you achieve your dreams?
At Howard Bailey Financial, we believe in the purpose-based retirement. We help you determine a clear plan of action to get you to your goal. We can help you review all of the variables, find and understand your options, and help you come up with a strategy that gets you closer to your purpose. Let Howard Bailey help you achieve the retirement you deserve.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
So going into the break, we challenged you with our question of the day. It has to do with asset class diversification. Which one of the asset classes had the best return in 2015? Was it large cap growth, emerging markets, international, or natural resources? Casey, which one of those is correct?
Well, the answer is A. That's actually the only sector, the only asset class out of those four that was positive during 2015. 2015 was a very difficult year for the market. Natural resources being down around 25%, emerging markets down around 15%, and we saw large cap stocks in that sector up around 6%. And so we saw a very difficult time for the market. And this is one of the years that really emphasizes the reason that we stay diversified. And there's even more reason to stay diversified in the world that we live in today because of all the different challenges that we have today. And there's a lot of different tools that we have today that we didn't used to have. So let's talk a little bit about that. One is, back in 1990s, our basic asset allocation mix was stocks, bonds, and cash. We really only saw it as three different asset classes. You'd have U.S. stocks, U.S. bonds, and then cash. But asset allocation today is much more colorful. We have large cap stocks, corporate bonds, commodities, small caps, international stocks, international bonds, government bonds, emerging markets, cash, tips. We have all these different options to create a truly diversified portfolio and reduce overall volatility. And if we look at this chart from 2006 to 2015, it further emphasizes that fact. This little gray box that you see here up in the top right-hand corner of your screen is where we saw those large cap growth stocks during 2015 returning 5.7%. But you can see that over that period of time, the previous 8 years, we never saw them at the top of that chart ever again. This is a mosaic of different asset classes, and we can see how much better one of those asset classes performs one year over the next. And your goal should be to deliver a consistent return for your retirement needs. Another issue we have is not just the variation in return, but also the correlation in return that we see between different asset classes, particularly our equities and that stock portion of our portfolio. From 1995 to 2000, we saw very little correlation between large cap stocks to small cap stocks to emerging stocks. They weren't all that correlated, meaning that we might see emerging market stocks up 10%, we might see U.S. stocks down 5%. Probably not that far in difference, but that gives you an example of what we're talking about in that respect. A perfect correlation would be 1 to 1. So we'd see 1 as the correlation coefficient. If we look at 2000 to 2015, we see that all of these different equities are getting much more correlated to one another, going from 0.6 to 0.67 in correlation to now being almost perfectly correlated. U.S. large cap stocks and international large cap stocks at a correlation that's almost nearly 1, 0.91%. This means your volatility in your portfolio is increasing unless you're also adding some alternative asset classes to the mix as well. For instance, we can add commodities to the portfolio. If we look at oil, gold, and the S&P 500 and chart them out over the last several years, we see that they reacted very differently to one another. We might have seen years when gold prices were skyrocketing and the market was seeing little to no growth. Now, what if we combine some of these and back test it? So we're going to look at the return and the risk of investing, say, directly into the S&P 500 or investing in commodities over the last 45 years. The S&P 500 over the last 45 years had an annualized return of 10%. And the risk level was 16%, or the standard deviation was 16%. If we look at the S&P GSCI, which is the S&P's commodities index, it annualized a return of almost 7% a year, with a risk level that was substantially higher at 20%. Well, if we would have blended those two, you may be surprised at what you get. With a 90% S&P equity allocation and a 10% commodity allocation, we would have had the overall return of the S&P 500 at about 10.22%, and we would have had a risk level that's about 15% lower at 14.9%. So we have to put diversification to work in your portfolio. Is that what's being done? Are you diversifying across different types of equity and different types of asset classes, both commodities and fixed income? And are you also diversifying your overall investment plan based on your individual purpose, not just for the sake of diversification?
Well, I don't know about you, but I don't trust myself to make those kinds of decisions. And so that's why I hope that you'll pick up the phone and be one of the next 10 people who are going to call us right now for a complimentary financial review of your entire financial and retirement plan. It's an opportunity to get some professional input, some real education about what's going on with your money, because we want you to make the best decisions for yourself moving forward, and I'm sure you do too. So for the next 10 callers, Casey and the team are willing to make time on the calendar, visit with you, and give you your very own purpose-based retirement. You know, you can learn a lot more about Howard Bailey Financial very easily. Just go onto the internet. Al Gore made all that possible for you. You can thank him by visiting howardbailey.com. You can also drop an email to Casey at info@howardbailey.com. And who knows, we might call you up and ask you to join us on a future broadcast and put your question on the air. There's also a new version of Casey's book available online as well. It's the 2017 Guide for Retirement Efficiency for the Purpose-Based Retirement, and it's available now for pre-order as well at howardbailey.com. That is the program for today. We hope you've enjoyed it. We hope we'll see you next week. You take good care.